Hello there. Thank you for joining me. If you're watching in the replay, I want to thank you for joining me as well. Once I record these shows, I do them live, but they stay on my feed so you could come back and enjoy them whenever you like. But seriously, we cover good stuff. These shows are made to be very current. We focus on the trends, short term, intermediate, long term trends, but we do make this show very much about the current moments and where do we go from here and what could you do consistently, regardless of where the markets go over the short term, because that's what we're about. We're about the long term, okay? And we want to make sure we're making the right moves. That's what this show is all about. I'm Mitch Goldberg. The name of our firm is Client First Strategy. Today, we're going to talk about a couple of things. I want to update you on some key metrics that really need, I think, a little bit more attention. That's the 30-year mortgage rate, the price of oil, the price of gasoline, the yield curve, which is now normalized, not by much. And most importantly, we expect the Fed to cut rates. It's pretty much a certainty now that the Fed's going to cut rates. It's just, does the Fed cut by a quarter of a percentage point or half a percentage point? And what exactly does that mean, cutting interest rates? So we'll get into these things. Here we go. Stick around. This is going to be very informative. Here we go. All right, welcome to the show. The big story is the Fed cutting rates. Now, let's just talk about what rate the Fed is expected to cut. The federal funds rate. This is the rate which banks use to borrow and lend between other banks. It's an important source of funds for banks' near-term liquidity, without which banks would have a very difficult time juggling the amount of money that they have to keep in reserves specifically every day. Just know that it's an important number. And it trades in a range. So really, the Federal Reserve guides the federal funds rate, but the rate is in a range that is settled by investors, by the market. So right now, the federal funds rate is bouncing between a range of 5.25% and 5.5%. And a lot of other rates are keyed off of that. And when you lower that rate, it makes more money available in the banking system, which means banks could have more money to make loans, plus to make loans cheaper for you, meaning lower interest rates. When you hear the term the cost of money, that's what you pay in interest. So if the cost of money is low, like let's say interest rates are 2%, you're going to borrow money at 2%, the cost of that money is low. But if you have to now pay 8% interest rate, well, that's 4 times, as much in terms of the interest rate. So you're paying a lot of money. The cost of your money's gone up to borrow. So when the Fed cuts rates and interest rates generally go down, it means businesses and consumers pay lower interest rate payments, which means that they have more money to save or to spend on other things. And it also gives consumers and businesses a little bit of a cushion, meaning that if consumers or businesses' revenues go down, they could absorb that because they're paying less money in their payments for things that they borrow or lease. So this, everything is tied to interest rates. I have some viewers out there, by the way. Thank you very much. If you don't mind, give us a thumbs up or a heart or whatever, or share your favorite emoji in the comments, as the YouTubers like to say. We just want to get the comments because it helps the algorithm do its job better and get the show out to more of your connections. And since this is all educational, you're helping. You're helping. Thank you out there. Oh, we just got the heart. Thank you, TLM. Thank you very much. I really appreciate that. By the way, the pictures you take in Florida are absolutely beautiful. And good for you. You live in a beautiful home. I'm very happy for you. So uh, we go on. So the Fed's expected to cut the Fed funds rate. The Fed started to raise the federal funds rate, meaning they started to raise interest rates uh, about 2 years ago when inflation started to jump. And the Fed got very aggressive and they were raising rates by a 0.5%, which is unusual. Usually when the Federal Reserve moves, it's a very gradual, slow moving institution where it moves like a quarter point at a time, not a half a point. The only other time I recall the Fed moving interest rates a quarter point, more than a quarter point in a single rate cut was right after 9/11 when the stock market opened up the following Monday. The Fed immediately cut rates by a 0.5%, and that was considered a big deal. But having said that, the Fed's expected to cut rates. It's near certainty that it cuts at least a quarter of a point. But the odds are about 50-50, even a little bit more than that, that the Fed cuts by a 0.5 point. I don't think it really makes that much of a difference. If you really believe that the economy is heading into a recession and economic statistics are deteriorating very quickly, and I could make the case for that, the Fed should cut more and quicker. 0.5 point now, and maybe 0.5 point the next meeting and the next meeting like that, and really bring down interest rates quickly to avoid the economy rolling over. And then there are those who worry that, well, inflation could still come back. Inflation is not necessarily dead for this cycle. And if you cut rates too quickly, you could spook the markets because then people think, what does the Fed see that is so dangerous that spooked them into acting out of their normal bounds? I don't think it's going to make a difference a quarter point or 0.5 point. I think a year from now, it's the direction that counts, not the magnitude of the depth of which the Fed could cut rates. If I was a Fed governor, I would want to say a quarter point. And if things do deteriorate more, or to the point where we really get spooked out that there's a recession, then then the Fed could cut rates by a 0.5%. The meeting after that, the Fed meets every 6 weeks to decide on what it's going to do with interest rates. They could always go a 0.5 point at the next meeting, but I think starting with a quarter point, just like when the Fed started raising rates to combat inflation, it raised rates by a quarter point, but then it quickly jumped to 4 0.5-point increases in a row. So the Fed is capable of getting in gear very quickly. So that is that. So we'll get that tomorrow. But the thing is, and I know that interest rates are like a special thing for investors because they say, oh, interest rates are going to get cut, so the stock market has to go up. But here's the thing. The Fed often starts to cut late when we are already entering or already in a recession. The Fed we have now is really being preemptive. It's not cutting. It's cutting rates because inflation is going lower, but it's not cutting rates because we've entered a recession. So the issue is, if the stock market has been climbing this year and the S&P 500 is up about 18% year to date, by the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. So we're having a pretty good year, but it's not like we've already gone into a recession or it's already started and the whole year's gains have been given up and the market's down like 10 or 15 or 20% on the year. And now the Fed comes in with rate cuts, and that's going to spark the economy and make the market go up. The market is already up, and by no means, in my view, in no way, shape, or form does the stock market reflect at current valuations a recession. In fact, stock market valuations say things are really good. By more metrics than not, I think we could make the case easily that the stock market is mildly to a lot overvalued as opposed to mildly undervalued or undervalued by a lot. So I don't necessarily believe that if the Fed cuts rates, the market has to go up. Now, if the Fed cuts rates and we don't have a recession, oh yeah, that's good for the market because then you get good solid growth, low inflation, lower interest rates, and that keeps a steady pace for valuations and ratios, things like that. That's a great thing for investors. We we shall see. And no one has a crystal ball. What are you changing though? Or what should you change in light of all this? I think I think for most of you, nothing. If you're an investor for the long term, you're investing in the stock market, the bond market, small cap companies, mid cap, large cap, et cetera. If you've got your allocation for your risk tolerance to meet your financial goals, your objectives down the road, I don't think starting in and out of the market and making changes based on what the Fed's going to do tomorrow or this cycle, if the Fed starts cutting rates and that it goes on for a while, it's a rate cutting cycle, just like we just had a rate hiking cycle. Now we go into a rate cutting cycle. And we don't know if inflation is going to come back or stay down, or it's tough to say. I could make the case for both. This is why I don't really spend a lot of time prognosticating what the stock market is going to do based on whatever economic circumstance you throw at it. What I do preach, though, is sticking with a portfolio that takes enough risk so that it could deliver a potential return, but not so much risk that it spooks people out of the market, out of their portfolio, so they could stick with their portfolio for the long term. Because sticking to a moderately aggressive or a moderate risk portfolio for the long term, I think will do much better for you than taking a lot of risk, but not being able to have the guts to hold on to your portfolio through the ups and downs. And then you just get out. And people don't get out of the stock market when times are good. Typically, people get out of the stock market when times are bad and times are scary. And they get back in when times are good. So I think a lot of people are trying to game the system. An awful lot of media is geared toward that to keep you guessing and making you think you have to do something, but you just need a little more information. You need the next economic statistic. You need to stay tuned for the next guest speaker on TV who's going to tell you exactly what's going on, and then you have to wait for the next person after him to counter what he said. And you wind up just watching markets for nothing, for a climax that never happens. And it's not really worth your time, in my opinion. And that's why, people say, oh, you must be going crazy when the market's down 1,000 points, or you must be, wow, or, the market's down, all the major averages are down, or all the major averages are up. A lot of times when people say that to me, I'm not even watching. It doesn't really matter. I still have to help my clients convert IRAs to Roth IRAs if that's what we should do, or help people pick the right location for their assets between a taxable account or a tax deferred account. Those sorts of things are going to help. Let's talk about the end of the year because it's getting here. We're going to talk more about this, and I'll wrap up the show. With the market up like this, it's a very bifurcated market. Dang, I wanted to use that word so badly today, meaning you've got a handful of stocks tied to artificial intelligence, which have done well, and a lot of stocks, the overwhelming majority of stocks, which may not have done that well, are tied to the consumer. But by and large, it's been a pretty good year for the market. And you have to now start to consider what you're going to do to not just make money, but keep what you made by being tax efficient. There are a number of ways that you could be tax efficient. Just so you know, I'm not a CPA. I'm not a qualified tax advisor. If you need specific tax advice for your situation, you need to speak with your personal tax advisor. But in the course of what I do, we do have to talk about taxes and capital gains and help people decide if they should make an IRA contribution or up their 401k contribution, or if they should take money from a Roth IRA first and hold on to their IRA money, et cetera, or how they should work things out with the required minimum distribution. So there's a number of things that people could do to reduce taxes. The first thing you could do, which won't cost you any money, which does not involve giving any money to a charity, is looking for tax losses in your taxable account and replacing those down stocks with new stocks. It could be a similar stock. Let's say you're down in Verizon. Maybe you sell that and buy AT&T, a similar company. Maybe you're down in, believe it or not, you could be down in a tech stock like Skyworks, for example, which is not doing so well this year, and flip that into another tech stock. So if tech stocks keep going up, you're still exposed to the sector, right? So you could still make money if that sector goes up. Or maybe if you have a stock like a consumer staple stock that's down, you could sell that and buy an ETF that tracks consumer staple stocks. Doesn't cost you any money, takes very little time to do that. The other things you could do is put money or raise your contributions to IRAs or 401ks. You're paying yourself. The downside is you're tying up that money into a plan, into a retirement plan. And for some of you, that might not be as palatable, or you might be older and it's just not something that makes sense for you at your stage of life anymore. Okay, that's another thing. It involves giving money away. Now, when I tell people if they're going to contribute money to a charity, you could just give away appreciated stock. You wind up doing better that way in this regard. If you give a stock that you paid, $10,000, let's say you paid $10,000 for a stock and now it's worth 20,000. Long-term capital gains for some of you could be 23% and change, but let's just say 20% in this example. You could sell the stock, pay the taxes on $20,000, and now you have to pay $4,000 in capital gains taxes, and you give $16,000 to the charity. Either way, you're at $20,000. Charity gains $16,000, which is a wonderful thing. But if you just don't sell the stock and give the charity the stock, then you wind up giving $20,000 to the charity instead of $16,000 to the charity, and the charity gets to sell that stock, and they don't have to pay bupkis in terms of taxes. So giving money away in that regard is a good thing. Now, if you're taking required minimum distributions, and sometimes a client will say, I don't even want that money from the required minimum distribution. I don't need it, but I have to do it. Well, you could do what's called a qualified charitable distribution and just give the money from your IRA. That's a required minimum distribution. You could give more also. Give that money directly to the charity. The charity gets the money, you make the donation, and the charity gets more because they don't have to pay the taxes and you don't have to pay the income taxes on your IRA distribution. The charity gets to sell the stock. They don't pay the taxes. You avoid the taxes from the required minimum distribution, and everybody's happier that way. So there are a couple more things you could do, but really the incentive for mostly getting out of taxable gains in your account is either tax loss harvesting, paying yourself more in a retirement account. Okay, and it could be an IRA, a traditional 401k. It could be a Roth component. You just get the tax benefit at a later date. Potentially, I should say. It's not a guarantee. Potentially at a later date. Or you have to give money away to charities. Okay, so that's how you could reduce taxes. There really aren't too many other ways to get around it. So if you have an issue with those or you want help with that, you are certainly free to ask me about that. Reach out to me or ask your advisor if you have one. If you have an advisor you're happy with, great. If you have an advisor you're not happy with that advisor, reach out to me. We can go over a second opinion and see if we're right to work together. We'll just speak with your CPA and things will hopefully work out for the best for you. Thanks so much for watching, and I will be back tomorrow.